Welcome to the debate. Welcome to breaking news to trading moves. When we look at mechanical engineering, say, the design of a high-performance transmission in a race car, there is a physical reality that engineers just have to respect. Every single time you engage that clutch, you introduce friction.
Right, there is a cost to every physical operation.
Exactly. You expose the gears to torque, you create heat, and you cause a microscopic amount of wear and tear. It is simply a mechanical certainty.
Yeah, the parts experience stress, regardless of how perfectly calibrated the machine might be. You cannot escape the physics of moving parts.
No, you can't. The action itself carries an inherent toll. And yet when we transition to financial markets, people often completely ignore this reality. They treat their trading capital, their execution platforms, and, well, most importantly, their own mental bandwidth as if they operate without any friction at all.
Which is a complete fallacy.
It really is. There's a very clear inverse relationship between trading activity and trading performance. Markets do not reward sheer activity. Instead, they reward decision quality, patience, and risk control.
So the core question being, does high trading frequency inherently degrade a strategy by multiplying your exposure to errors and costs? Or is overtrading actually a misdiagnosis? Is the real issue entirely separate from the sheer number of executions and instead a breakdown in emotional discipline and process adherence?
And that is exactly the central disagreement we are exploring today. I am arguing that high trade frequency is a mechanical hazard. It directly destroys capital, making strict limits on activity a necessary defense.
And I am arguing that frequency is completely harmless, as long as a strict process is maintained. The real hazard is the emotional breakdown that occurs long before a bad trade is ever placed.
Well, let's lay out the groundwork from my side of this. My position is that frequency itself is a mechanical vector for risk. Reducing your trade count is a primary, necessary defensive mechanism.
Okay, but defensive against what exactly?
Against yourself, mostly. The more frequently you interact with the market, the more chances you create for emotional, technical, and risk management errors. The market does not pay for screen time. It pays for selectivity.
Right.
When you force entries outside of a concrete plan, you directly lead your portfolio into a mathematically hostile environment. You pay a heavy toll through spreads and slippage. By deliberately keeping your frequency low, you naturally insulate yourself from these compounding frictional costs.
See, I come at it from a different way. I believe demonizing frequency completely obscures the root cause of poor trading. While the visible problem is the unnecessary entry, the real problem begins much earlier.
Elaborate on that.
Well, I argue that frequency is entirely neutral. A high number of executions is completely acceptable, provided every single one meets the strict criteria of a repeatable condition. The hazard does not lie in acting often. It lies in the pre-trade psychological state, the fatigue, the boredom, or the frustration. Precisely. If you fix the standards, the frequency takes care of itself.
Let's explore this illusion of activity versus actual opportunity, because this is where the trouble usually starts. People very often fall into a basic, linear, logical trap.
The multiplier effect.
Right. The mind says, if this one specific setup makes me $1,000, then finding 10 more setups today will create 10 times the profit. But we know that some sessions offer absolutely nothing worth taking.
Sure.
When someone presses for action during unclear conditions or unpredictable volatility, they are invariably turning their own boredom into unnecessary risk. The belief that activity equals productivity is a fatal flaw in this arena.
I'm sorry, but I just don't buy that. Let me tell you why. You are framing activity as if it is naturally born from boredom or impatience. But what if the activity is born from a highly robust system?
That's a big what if, though.
But hear me out. If a strategy generates valid setups, executing them isn't just an option, it is mathematically required to realize the edge of that system. If you place an arbitrary limit on your trade frequency, say, restricting yourself to 2 executions a day, are you not just using that limit as a crutch for bad system design?
I wouldn't call it a crutch.
But it is. The focus must be on executing only when the setup is complete, regardless of how many times that condition materializes in a given session.
I see why you think that, but let me give you a different perspective using that physical mechanism analogy we started with. Trading is not a theoretical exercise. It happens in a frictional environment.
Okay.
Let's actually break down the mechanics of an execution for a moment. When you decide to enter the market immediately, you don't magically get the exact price flashing on your screen. You have to interact with the order book. You have to cross the bid-ask spread.
Right, the gap between what buyers are willing to pay and sellers are willing to accept.
Exactly. To guarantee your entry right then and there, you pay a premium. You cross that gap. That means the absolute second your position opens, you are mathematically at a loss. Now add slippage to that.
The execution delay.
Yeah, the reality that in fast-moving conditions, the price changes in the milliseconds between when you send the order and when the exchange actually matches it. These are not minor details.
I'm not saying they are.
Do that 50 times a session instead of 5. Those compounding transaction costs act as a massive geometric drag on your capital. The sheer volume of execution attempts introduces an operational headwind that no system can purely optimize away.
But the drag you are describing, the spreads and the slippage, those are known variables. A proper risk-to-reward ratio accounts for them before the order is ever routed.
In theory, yes.
Not just in theory. If your expected value cannot survive the cost of the spread, then you don't have a valid setup to begin with. You mentioned traders forcing entries and taking weaker setups outside their plan.
Which they do constantly.
Right, but if the setup is outside the plan, it is not a system execution, it is an emotional failure. You are blaming the sheer volume of activity for what is actually a failure in compliance.
I'm not convinced by that line of reasoning because it assumes a robotic consistency that human beings simply do not possess. When you force yourself into a high-frequency posture, you are demanding an unsustainable level of cognitive perfection. Let's look at the biology of decision fatigue.
Ah, the depletion of the prefrontal cortex.
Precisely. The prefrontal cortex is the part of your brain responsible for complex planning, risk evaluation, and impulse control. It requires a massive amount of metabolic energy to function. Every single decision requires analysis, execution, and subsequent management.
Sure, trading is mentally taxing.
It's more than taxing. Every time you evaluate a flickering tick, every time your brain processes the dopamine hit of an unrealized gain or the cortisol spike of a sudden drawdown, you burn cognitive fuel. If you are doing that 30 times a session, the mechanical wear and tear on your psychology guarantees that by decision 20, you are biologically incapable of evaluating risk the same way you did at decision 1.
But
You'll begin to accept suboptimal conditions because your mental capital is totally depleted.
that brings us exactly to the pre-trade psychological state, which I argue is the true battleground here. You are describing the mechanics of execution, but the failure happens in the psychological prerequisites of the operator.
Right.
The real problem begins before that 20th execution is ever placed. A person loses discipline when they are tired, frustrated, or when they feel the market owes them a recovery after a sudden loss. It is these specific emotions that quietly lower their standards.
Yes, exactly.
A setup they would normally reject suddenly looks acceptable purely because they have a psychological need for action or a desperate need to make back a loss. Therefore, the remedy is rigorous psychological self-monitoring, not some arbitrary cap on how many times you click a button.
I agree that emotions lower standards, but you are completely missing the causality here. The frequency is the exact catalyst for that emotional exhaustion. How can anyone possibly maintain peak psychological neutrality over a high volume of complex, risk-based decisions?
By having an ironclad process.
But the very act of constant market interaction, the continuous exposure to the noise, drains the precise discipline required to reject weak setups. It is this constant engagement that leads directly to revenge trading. You cannot separate the psychological breakdown from the frequency of exposure.
That is a compelling argument, but have you considered that an operator who acts infrequently can be just as emotionally compromised?
How so? If they are acting less, they are preserving that cognitive fuel.
Not necessarily. Think about the psychology of someone who waits all week for one specific setup. They can become so desperate for that single opportunity to work that they build immense psychological pressure around it.
Okay, I see where you're going.
When the moment finally arrives, they might freeze and fail to execute because the stakes feel too high. Or worse, the trade goes against them and they refuse to cut the loss because they have entirely too much emotional weight riding on a single instance.
Holding on to a loser because it's their only play.
Exactly. They refuse to accept that their one trade for the week is a loser. The fatigue and the poor decision-making don't just come from frequency. They come from unresolved psychological pressure.
So you were saying the desperation exists independently of the volume of trades.
Yes, completely. If a person feels they missed the morning's best move and they are desperate to catch the afternoon's move to make up for it, that desperation exists whether it's their second decision of the day or their 20th.
Right.
The self-monitoring required to identify that feeling, to stop and say, I am operating from emotion rather than evidence, is the actual skill. The frequency of the trades is just the arena where the lack of skill is exposed.
But let's look at how we actually protect that skill in practice. A professional is paid for selectivity. Professional thinking means accepting that not every market condition deserves participation. This leads us directly to the concept of sitting out and the vital rule that cash is also a position.
A highly underutilized position, I'll give you that.
Entirely underutilized. When price is moving without clear structure or when volatility drops and the ranges tighten up, the spread and slippage we talked about earlier suddenly represent a much larger percentage of the potential move.
Because the profit margins shrink.
Exactly. In those environments, sitting out preserves both trading capital and mental focus. By consciously reducing the amount of executions, you build a fortress around your mental capital. It allows you to step back, review decisions clearly, and focus strictly on higher quality setups when the environment actually warrants risk.
I am with you on that. Cash is absolutely a position, and preserving focus is paramount. However, we have to define what dictates that position. It cannot just be a vague feeling that you have, traded too much today.
Well, it shouldn't be vague.
Right. A strong process is built around repeatable conditions. You must know exactly what has to happen before you enter, exactly where the thesis is invalidated, and exactly how much capital you are prepared to lose. If those criteria are not met, you sit in cash. But if those criteria are met, action is required.
But action, it is always a choice.
A choice dictated by the system. The danger is the lack of defined boundaries, not the act of taking multiple trades. Let's say the structure is remarkably clear and the risk-to-reward ratio is highly attractive 4 times in a single morning.
Okay.
You take the 4 trades. You don't ignore the 4th one just because you hit some imaginary daily limit.
But realistically, how often does that actually happen? You have to be realistic about market dynamics. High probability, highly structured, clean setups do not occur with that kind of rapid-fire frequency.
It depends on the time frame, but sure.
The market is incredibly efficient and mostly operates in random noise. When you truly demand a clear structure, an attractive risk-to-reward ratio, and a fully complete setup before putting capital on the line, you naturally filter out the vast majority of that noise.
I agree with that.
So the act of enforcing those strict boundaries inherently lowers your frequency. While you argue that frequency is neutral, the practical application of a strict process mathematically results in fewer trades.
Well, it results in fewer trees compared to an undisciplined operator. Yes, I don't disagree with the math on that. But it does not dictate a mandate to trade less just for the sake of trading less.
It's not for the sake of it, it's for survival.
But saying out is an active decision. It is not laziness. People often feel a compulsion to act, simply to justify their time sitting in front of the monitors. They want to feel productive. I agree completely that this compulsion is the enemy.
Good, we have some common ground.
Yes, but if we simply tell someone, reduce your activity, without demanding they construct a rigorous framework of repeatable conditions, we are treating a symptom while ignoring the disease.
Treating a symptom is sometimes exactly what you need to do to stop the bleeding. But it doesn't cure the patient. If you just mandate a lower frequency, they will simply take 2 terrible, emotionally driven trades a day instead of 10. They must learn to monitor their internal state.
Right.
They need a pre-trade checklist. Have I reached my daily loss limit? Am I operating from frustration? Is the setup actually present, or am I just bored? That internal audit is the true mechanism of risk control.
I hear that. I do. But treating the symptom can save the portfolio, while the cure, that internal audit skill, is being developed. It takes years to build the kind of bulletproof psychological self-monitoring you're describing.
It does take time. So, by structurally limiting activity from day one, you physically limit the damage a compromised psychology can inflict. You limit the spreads paid, you limit the slippage endured, and you limit the sheer number of opportunities you have to make a disastrous account-ruining decision. Unnecessary executions almost always create unnecessary risk.
And we return to the definition of unnecessary. An unnecessary execution is one taken outside the plan, driven by boredom, fear, or frustration.
Exactly.
A necessary execution is one that perfectly meets the objective criteria of the setup. The discipline regarding those objective criteria and the vigilant monitoring for emotional fatigue is the true edge.
I think we're looking at two sides of the same coin here.
Maybe. The actual number of executions on the blotter at the end of the day is entirely secondary to whether the process was maintained. If you followed the rules, the number just doesn't matter.
Well, it seems we have drawn our lines pretty clearly on the mechanics. I am arguing that limiting activity is a necessary structural defense against the compounding risks of emotional fatigue, slippage, and forced entries.
Right.
The sheer friction of market interaction demands a highly selective approach, treating trade frequency itself as a primary vector for risk.
And I maintain that process adherence is the ultimate defense. Discipline regarding the objective criteria of the setup, combined with rigorous self-monitoring for emotional interference, constitutes the true edge.
If the criteria are met, the frequency is completely justified.
Exactly. And if they are not, even a single execution is one too many.
Despite our different angles on the mechanics of frequency, we absolutely converge on the core philosophy when we look at the reality of the markets. We both agree that the market never rewards activity purely for the sake of feeling productive.
Never.
Forcing action to satisfy an internal emotional need is universally destructive.
Precisely. The market is entirely indifferent to how much effort you feel you're putting in. It doesn't care if you have been staring at the screens for 10 hours or 10 minutes. It only pays for the quality of the execution when the mathematical odds are genuinely favorable.
We will leave the final judgment to you, the listener. Take a moment to evaluate your own history. Look at your own records. Is your activity level truly driven by genuine, repeatable conditions?
Or is it being driven by an underlying psychological need for action, a subtle fear of missing out, or a desperate desire to force the market to pay you for your screen time?
It is a difficult question to answer honestly. It requires you to confront your own ego.
Oh, absolutely. But it is exactly the kind of relentless self-examination that separates professional thinking from amateur reacting.
Think back to that high-performance transmission we discussed at the start. Every time you engage the mechanism, you are introducing friction, paying a toll, and causing wear and tear on your machinery.
The physical reality.
Right. Before you push that pedal, you have to ask yourself, is the road ahead clear enough to justify the toll? Or are you just spinning the gears to hear the engine roar?